and welcome to our class on stochastics, sponsored today by Legacy FX, one of the world's leading providers of Forex and CFD trading. Now, Legacy is a fully licensed and regulated Forex and CFD provider, and therefore, if you can't access their site in your home country, means that they're not regulated and they do not provide services where they are not regulated. When you trade with Legacy, you have a choice of 4 different platforms, and you can use one of them or all of them. You can download the MT4 Trader software and trade on the MT4 platform. You can use their Xeric station, their mobile trader, or their web trader. You can go from one to the next, or whichever one you feel comfortable with. But they're all easy on the eye and dynamic, easy to use, easy to set up, and customizable to your own needs. Now, Legacy's philosophy is simple: offer focused and personalized services that makes trading logical. They also provide an exceptional education center because they want you to be successful in your trading. They offer a full range of deposit and withdrawal methods. They have their Legacy FX Pro Rewards program. They have dynamic security, and of course, as I mentioned, their extensive trading academy. Now, since Legacy is a regulated provider, I am required to give you a risk warning. So I'm going to read the first paragraph, and I would appreciate it if you could read what's on your screen. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 76% of retail investors' accounts lose money when spread betting or trading CFDs with Legacy. You should consider whether you understand how spread bets work, how spread bets and CFDs work, and whether you can afford to take the high risk of losing your money. Now, today's class is being recorded, and if you wish to see a recorded version of this class, you can do so in about 24 hours by using the same link you used to come to this live class, and you'll see an unedited version of that, or when investing.com has had time to edit it and clean it up, you'll be able to find it on the investing.com website, where you signed up for the class, and look under education and then look under webinars on demand. And in fact, there you can see all the webinars we've ever presented in the last, I think, 7 years now. So let's get started talking about one of the leading technical indicators known as stochastics. Now, in today's class, I'm going to intermix the term security. I might say asset. I might say Facebook. I might say Google. I might say Bitcoin. But I'm not really talking about any specific asset. I'm talking about all publicly traded financial instruments. I also intermix the term investing and trading. Basically, technical indicators work best for traders. Investors are looking for other pieces of information for long-term investments. But we know the difference between investing and trading. But I use them back and forth because it also gets very boring saying trading, 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 trading. There's not even another word I can use, online trading. So we use investing or trading. Now, stochastics falls into the field or the science of technical analysis. Now, whether I'm going to do a seminar, a webinar, a class, a one-on-one presentation, wherever I'm going to meet traders, wherever people find out what I do, the first thing they ask me is, what should I buy? What should I sell? What will prices of gold be tomorrow? Will Bitcoin keep going over 10,000? Wouldn't investing be easy if we knew the answers to these seemingly simple questions? But I don't have a Ouija board and I don't have a crystal ball, and anybody who tells you they do is full of it. Now, are there ways that we can move things or interpret things better? Yes. But the only thing that makes a determination is price action, and nobody can predict where price is going to be. Now, stochastics can help us time trades, whether we're getting in the market or out of the market, because it basically gives us what we call overbought and oversold signals. So Have you ever had an apple fall on your head while sitting under an apple tree? No. But you all know the famous story of Sir Isaac Newton and how he formed the universal laws of gravitation. What goes up must come down. Now, it's true not only of apples, but it's true of the financial markets as well. And there are several chart oscillators that try to identify price turning points that investors might explore. And stochastics not only falls into the area of technical analysis, it falls into a very specific area called technical indicators, which is a sector of technical analysis. And under technical indicators, we have an area called oscillators. And oscillators are named such because they jump up and down between a specific level or specific barrier. So they oscillate. So one of the many regularly followed trend indicators is stochastics. It measures the distance between an asset's closing price and the range of highs and lows over a specific period. Now, that's a lot of mumbo jumbo, but that's what it does. But if you were to think that when an asset is rising or trending up or the market's starting to build momentum in a direction, the asset will most likely close that time frame towards the upper part or towards its high. When an asset market is coming down, it will most likely close each period, even if it doesn't make a new low, close towards the lower point because the bulls are either pushing up or the bears are pulling down. And let's not just talk about the close, the highs and the lows. If the bulls have a lot of momentum, they may not close that much higher, but they should push that price up. They might have eased out, but they still should be making new highs. Same thing in a downtrend, because we're only concerned with trending markets. Proponents tend to like the stochastics oscillator because it's easy to remember the defined range of 0 to 100. What this means is no matter how you do the mathematical calculation for stochastics, it will always come out between 0 and 100. And it helps us see support and resistance, and it gives us the ability to signal divergence. Now, the oscillator, or stochastics, was developed by George Lane, and he developed this into what we call overbought and oversold ranges between 80 and 20. Now remember, I said the mathematical calculation will always come out between 0 and 100. Then he's put up, those are the outside barriers, and then he's put up an inside fence above 80 and below 20. Now, a lot of people talk about 75 and 25 because the markets allow you, and whether you're using RSI or stochastic, they allow you to customize this. There's a lot of pieces that you can customize. So let's go look at this on a chart so you kind of get a better grasp of it. Hold on a second. Let me pop up a chart here. Now, this is my standard teaching chart. And I haven't picked the Euro US dollar for any other reason except this is the chart I use for class. Now, when you calculate stochastics, it's either going to come out between 100 or 0. But it's got a range of 80 to 20. Okay, so this is where the fence has been erected. So this is the outside borders, and this is the fence. When price, it's said, and a basic interpretation is when price is above 80, it is in what we call overbought. When it is below 20, it is considered oversold. Now, a lot of people think that's a really significant piece of information. Personally, I don't. Because an asset that is over 80 or moves into overbought can remain overbought for quite some time. If it moves into oversold, it can remain oversold. Too many people think when the market's overbought, it means to sell. And when it's oversold, it means to buy. But it doesn't. Okay, it's just telling you the market's too heavy. That's it. But an overbought market can stay way overbought, or you can see stochastics like you did here. Well, there's not a good example here in today's trading, but sometimes stochastics will come up above and then come below and then go back above and stay above and then come below and stay above again. Okay, it's not the market's just jumping into overbought and overbought and overbought. It just isn't. And then there's also a lot of times a lot of assets will tend to always be above 80. They will tend to hold in the 90 range. And the fact is, they can't go above 100. So when an asset is really pushed up really high, where else can it go? So these are some fallacies. But this makes it not so simplistic to simply use the words overbought and oversold to use as indicator. Now we're going to go back and talk about what these lines are once we talk about the barriers. Now these barriers can also be customized. Meaning a lot of people will use the upper band at 75 and the lower band at 25. They'll get more overbought and oversold signals, but some people are more comfortable with this. You have to, whenever you customize an indicator, you have to understand its different interpretations and back test it to make sure it's doing what you think it's going to do, because it can show you in a short range that it's just doing exactly what you want, but it really isn't. It's just happens to be what's going on at the moment. Now, this is the border lines. Okay, so let's go back and put this back at my 80 and 20. Now, the only reason I mentioned the 75 and 25 is because there's a lot of strategies out there. It is a known accepted range. Okay. George Lane developed 80-20. The markets over years, and depending on the faster moving markets, and like for Forex, 75 and 25 is sometimes a lot better. So that gives us our barrier. But before we do anything in a barrier, we have to put some lines to tell us where the price is. So if you notice, we have two lines on stochastics. One's called a K line and one's called a D line. And these are currently set in the standard default of the K line is at 14, the D line is at a 3, and the smoothing is at a 3. Now, the K line in my case here, actually, let's make it much more. I just want to make it more obvious for you. Okay, so this big, bold green line is the K line. The D line is, we'll leave that with orange, but we're going to make that a little bit bolder. So we have the green K line and the orange D line. Now you thought you were going to get away without doing any mathematical calculations, but that's not going to happen, because you have to understand you never ever have to calculate these lines ever again in the future. Okay? They will automatically be dropped on your chart. But if you don't know where the lines come from, you can't spot when they're telling you inconsistencies or there's something wrong with them. Okay? And you have to have some basis of knowledge. So let's go back to my PowerPoint. Let's talk about where these little lines come from. In fact, I'm going to use a little presentation, and then we'll go back and talk about these K and D lines. So let me share with
Here's a badly drawn example of what it might look like. You can see why I'm not an artist. So we have the price here. This is what the price is doing. This is the market, whatever market it is. Then we have the percentage D line. Let's say this is a 10-day stochastic. So that will be our percentage D line with a value of 3. and then we have the percentage DN line, which is just a smoothed out version of that red line there. So using it simplistically, we have our overbought and oversold areas that we're maybe used to from things like the RSI. So that might be 70% and 30%. When the market goes below 30%, it's said to be oversold. We're expecting a bounce, but the signal comes from the percentage D line crossing through that DN line. So hopefully you can see that. We'll look at it in a real market in a minute. The sell signal comes when we go to the other extreme. We go above the 70% line here, and the stochastics hook lower. That would be our sell signal. And we also have this idea of divergence, which we've talked about before, where, for example, here the market pushes to a low, but our stochastics start trending up. That's known as bullish divergence, and can be a suggestion that maybe the weakness is running out of steam. And up here we have the opposite of that, where the market pushes out to fresh highs, but our stochastics are falling. That's known as bearish divergence, so it can be a suggestion that maybe the market, the rally, is starting to lose some momentum and it could be time to go short. So a couple of ways to use it: the simple crossover approach here, and also the spotting these divergences where the market does one thing but our stochastics are doing something.
So like I said, you're not going to get away without doing any of the math. So let's go back to my PowerPoint. And we are going to start looking at where these calculations come from. Now, if you notice on your screen, there's a little place that says handouts. I've put together 3 handouts for you. Okay, the one is the Stochastics guide. It will explain basically what we're talking about in class today. I put that together with you with some sample charts and some explanations. I've also given you the technical indicators guide handout, which goes over the different classes of technical indicators and what they are and what and at which area they fall in. And then I've given you the top technical indicators explained, which will be an explanation of not just stochastics, it's going to give you RSI, the 5 most important or the most well-known indicators. So, ready? The fast-moving line is shown as a percent K line, and the slow-moving line is the percent D line. Now, the Stochastics Oscillator is a momentum indicator comparing the closing price of an asset to the range of its prices over a certain period of time. Now, the standard default is 14-period look back and a 3-period sensitivity range, and then a 3-period moving range. So the general theory serving as the foundation for this indicator is that a market trending upward, prices will close near the high, and in a market trending downward, prices will close near the low. Transaction signals are created when the K line crosses through this 3-period moving average, which is called the percent D. So it's a very simple calculation. Okay, it's not complex. It's one you can do right on your with a little calculator right on an Excel spreadsheet. But like I said, you'll never have to do it. Okay, but you need to understand it. So the percent K line, which is the primary line, is formulated as 100 times C, which is the current close, minus, and if we're using a 14-period look back, the lowest point of the 14-period previous trading sessions, divided by the highest point of the 14 periods trading session minus the lowest point. So C is the most recent closing price, L14 is the low of the 14 previous periods, and H14 is the highest. So it's a simple calculation. We take 100 times the current close minus the lowest period, divided by the highest period minus the lowest period. Then we take that, we plot that on our chart, and it's always going to come out between 0 and 100. And then we just simply take that and add the last 3 K lines together, divide it by 3 and plot that on our chart, and that gives us our percent D. So the percent D is simply a 3-period moving average of the percent K line. So the general theory serving as the foundation for this indicator is that in a market trending upward, prices will close near the high. In a market trending downward, prices will close near the low. The transaction signals are created when the percent K crosses through the 3-period moving average, which is called the percent D. So let's go back to my chart that we made those big bold lines on. So we have our percent K, which is our green line, and our percent D, which is simply the moving average of the K line. It gives us buy and sell signals when they cross each other. So here, here, here. As you notice, it happens quite often. But this crossover means very little to us. When they cross over in the middle of the fenced in or the barrier lines, which we can call no man's zone, it's really not telling us anything. It's when it crosses over near or above or below those barrier fences. So when it crosses above or below the 80 or the 30 and the 2 lines cross over, then we get more reliable signals. But as you see in a fast moving market, okay, and like I said, this is my standard teaching. I didn't pick the euro, US dollar for anything. Now, if you notice, the movement doesn't actually go match. Some indicators look exactly like price. Stochastics does not. Now, Stochastics here is in the middle of a congestive area. And even though it's giving us crossovers, when we get the crossovers in here, it doesn't tell us anything. Here, okay, we got the crossover and Stochastics was below. It gave us a buy signal, but the question is, could we have made any money? Okay, just because something tells you something's going to fall or climb, but it doesn't tell you how far it's going to go or how much momentum it has, doesn't really help you with anything, does it? If I tell you to buy Bitcoin at 10,000 and my indicator saying buy, I buy, but the price only goes up to $10,002. Was my indicator wrong? No, my indicator was completely right. It said it was going to go up, but it didn't go up enough for me to cover the cost of my trade and for me to get in the market and get out of the market. So that becomes a funny little problem for us. And this is why you have to know how to read this indicator, because if you just simply try to read it by these minor little clues, you're going to get yourself in trouble. Now, one of the more popular ways, that the market tries to take this into account is by changing the formulation, by changing the inputs. So a lot of people today, because online trading has changed a lot, and we're trading in a very fast-moving market, have moved to a 1466. So it's using a 14-day look back, a 6-period moving average. Now, if you notice, by doing that, I got a lot less signals, I got a lot less overbought, and I start to see things that kind of make sense to me. We also have people, or one of the other standard combinations is a 1066. Because they say this is such a fast-moving market, we don't, a 14-period look-back period isn't that valid. So then a lot of people use a 10-6-6. It will give you less signals, okay, but they will give you more reliable signals or easy to interpret signals. Now, I happen to be a firm proponent of 14-6-6. And like I said, there's all types of strategies out there that you have to learn. And different markets and different assets tend to be different. So this is one of the things when you trade a zillion assets, it's hard to get to know their personalities. And without knowing the personalities of the assets, you might misinterpret what it's doing. But see, the stock market moves relatively slow and in larger numbers. So 14-3-3 works extremely well in the stock market. 14-6-6 works well in commodities. It works well in online trading of Forex. But things like cryptocurrency work much better in a 10-3-3, a 10-6-6. But you'll start to see whole sectors, but you'll have to personalize that, or you'll have to learn a strategy about that. Okay. So it's not just making assumptions. I'm going to do this, this, and this, and it's going to just tell me everything. So let's see how we would use this in trading. So I'm going to share with you another presentation.
The stochastic indicator is one of the most popular technical analysis indicators used by forex and stock market traders. Once you understand how to correctly use it, the stochastic indicator can be an invaluable tool to help predict momentum changes. Most traders get confused about how to correctly read the stochastic oscillator signals under varying market conditions. You see, you need to apply a specific type of stochastic trading strategy when the market is trending, but you need to read the stochastic indicator very differently under range-bound market conditions. If you misinterpret the market environment, the same stochastic oscillator value can translate into a very different signal. This is where most traders fail. They simply apply the stochastic oscillator in the same manner, regardless of the underlying market condition, and end up losing money as a result. So what is a stochastic oscillator? Stochastic oscillator is a momentum indicator which compares where the price closed relative to the price range over a given time period. The stochastic is displayed as two lines, the main line called K% and the second line called D%, representing a moving average of the K%. Traders use two types of stochastic, the fast stochastic and the slow stochastic. The fast stochastic oscillator is very volatile. Its reaction to market price will generate many signals. In a strong trending market, the fast stochastic isn't able to filter noise and will offer a lot of false signals, which will lead to bad trades. In order to manage the signal in a more efficient way, the slow stochastic oscillator was developed. The slow stochastic oscillator helps to smooth the noise and replaces the K% with the D% line and replaces the D% line with a 3-day moving average of the D%. Slow stochastic oscillator was basically designed to reduce volatility, but in a strong trending market suffers from the same problem as the fast one. It offers many false signals. Stochastic oscillator comes with the standard 5, 3 and 3 settings. Other common settings are 8, 3 and 3 and even 14, 3 and 3. Depending on your trading style, you have to decide how much noise you are willing to accept with the stochastic. Low values for the stochastic oscillator will make the indicator oversensitive. A stochastic with lower settings will offer a lot of signals, but also comes with a lot of market noise. Higher values for the stochastic indicator will make it less sensitive to market noise. This will lead to fewer signals as the indicator is smoothed. If you want a higher number of signals when you trend trade, then lower settings on the stochastic will suit you. If you are a swing trader or a position trader and want to eliminate market noise, then higher settings on the stochastic will help you to do that. A lot of traders look for the perfect settings on the stochastic indicator when they trade the forex or the stock market. The reality is that there isn't one. You just have to know your trading style. You then have to backtest different settings depending on the market you are trading and the time frame you are analyzing. I prefer to use the stochastic oscillator with 8, 3, and 5 on higher time frames. Now, how to use the stochastic indicator. The most popular method of generating entry signals, but not a smart one, is to consider the stochastic indicator as an overbought and oversold indicator. The majority of trading books teach you that a buy signal occurs when the stochastic moves below 20 level into oversold area and then crosses back above that threshold, and the sell signal occurs when the oscillator moves above the 80 level into overbought area and then crosses below that threshold. Here's the reality. This strategy works only during non-trending conditions and will fail during strong trending phases. During a non-trending market, the stochastic generates some pretty good signals. In a trending market, however, the stochastic oscillator generates a lot of false signals. The misconception of overbought and oversold is one of the biggest problems and faults in trading with stochastic. After many years and a lot of money lost, I've realized that stochastic indicator does not show oversold or overbought prices. It shows momentum. When the stochastic is above 80, it means that the trend is strong and not that it's overbought and likely to reverse. A high stochastic means that the price is able to close near the top and it keeps pushing higher. A trend where the stochastic stays above 80 for a long time signals that momentum is high and not that you should get ready to short the market. You see this concept on every chart. The price enters an overbought area during a strong trend and stays overbought for a long period. You don't want to be in the position of traders that shorted the market hoping for a reversal. A smarter entry would be on the long side against traders that considered that the price is overbought and incapable of going higher. The second most utilized stochastic oscillator signal is the crossover signal, which happens when the K% line crosses above the D% line and generates a buy signal. On the other hand, when the K% line crosses below the D% line, it generates a sell signal. Once again, these stochastic oscillator crossover signals are reliable during a range-bound market, but these signals tend to become a lot less reliable when the market is in a strong trend. You can still rely on the stochastic oscillator crossover signals as a trend continuation signal. For example, if the market is in an uptrend, you search only for crossover buy signals on the stochastic oscillator, so you're not interested in shorting the market. You simply want to ride the trend by taking buy crossovers. Similarly, if you see a crossover sell signal during a downtrend, you can also rely on the signal as supporting evidence that the downtrend is likely to continue, ignoring buy opportunities. Maybe the most elegant approach is to look for price oscillator divergences. A divergence occurs when the price action differs from the action of the stochastic indicator. In other words, the market momentum isn't reflected in the price, which could be an early indicator of a reversal. A classic divergence occurs when the price forms a lower low, while the stochastic forms a higher low, indicating a possible buy, or when the price forms a higher high, while the oscillator forms a lower high, indicating a possible sell. When a divergence occurs, a potential change in price direction could be on the cards. This is my favorite method to trade with the stochastic oscillator. I determine the main trend with the 200 period exponential moving average, and I only trade classic divergences in the direction of the main trend, so I ignore the divergences that occur on the pullbacks or corrections of the main trend. Basically, when the price is above the 200 EMA, I search for divergences on the lower side of the stochastic, and when it's below the 200 EMA, I look at the upper side of the indicator.
Now, if you notice in the last edge of the presentation, they were talking about combining stochastics with moving averages. Now, stochastics is not a standalone tool. As with any other trading concept or tool, you should not use stochastics indicator by itself. To receive meaningful signals and improve the quality of your trades, you can combine the stochastic indicator with these three tools. Moving averages. Moving average can be a great addition here, and they can act as a filter for your signals. Always trade in the direction of your moving average, and as long as price is above the moving average, only look for longs, and if price is below the moving average, only look for short-term sell opportunities. Price formation. As a breakout or reversal trader, you should look for wedges, triangles, and rectangles. When price breaks such a formation with an accelerating stochastics, it can be potentially a signal of a successful breakout. And then lastly, trend lines. Especially stochastics diversions or stochastics reversals can be traded nicely with trend lines. You need to find an established trend with a valid trend line and then wait for price to break it with the confirmation of your stochastics. Now, too many people try to combine too many types of indicators together, and they don't realize they're using the same indicators to tell you the same thing. One of the biggest things that I talk to people all day long, I hear about them using RSI and stochastics. Basically, RSI and stochastics will always give you the same reading, the same indication, because they are both the same type of indicators. So you should be combining other types of indicators. You should be using maybe a trend indicator with a momentum and a volatility indicator, not just indicators to give you overbought and oversold zones. So you might not need the stochastics indicator when you are able to read the momentum of your charts by looking at the candles. But if the stochastics is a tool of your choice, it certainly does not hurt to have it in your charts, in your arsenal. More importantly, you need to realize how little you might know about using the tools. Additionally, there's a lot of wrong knowledge being shared among traders, and even widely used tools such as stochastics is often misinterpreted by the majority of traders. Do not blindly believe what other traders tell you, and do your own research and build your own trading knowledge. Traders will often cite that when an asset moves a higher high, but the stochastics does not exceed its previous swing high, that the trend is in jeopardy. This couldn't be furthest from the thing. Traders will often exit trades when the slow stochastic crosses above 80, or will buy when the slow stochastic crosses under 20. The problem with this trading methodology is that an asset over 80, it should not be looked upon as overbought, but rather as trending strongly. Also, if the stochastic is below 20, this is a sign of weakness without any other form of support present. The stock will likely just continue lower. So there are 4 basic trading strategies you can use when trading stochastics. The strategies increase in complexity as we progress through each example. Please approach each strategy with open mind, as this will challenge the conventional thinking. So number 1 is identify stochastics with smooth slopes. Stochastics that have smooth slopes, which move from overbought to oversold, implies that the move down was sharp without much reaction, thus strengthening the odds of a counter move up. While this is the simplest of stochastic strategies, it has its flaws. After you get a few of these under your belt, take my word, you will realize that you need more than a slow stochastic move. While this strategy is the simplest, it doesn't always make profits. Strategy 2 is follow the sloppy stochastics. Far too often, new traders will buy overbought and sell oversold. Remember, the slow stochastics is an oscillator like any other oscillator. It can trend sideways for an extended period of time. Slow stochastics will give you false signals. you'll see how slow stochastics just sitting below the 20 line, and you can say to yourself, it's time to go long. Trust me, you won't say this for long. Now, combine slow stochastics with trend lines. When you seem to have a trend break and a stochastics in overbought or oversold, you then have a perfect formula. Remember, trading is not as simple as just black and white. Do this, and do this, and you're going to make money. Now, I don't want to leave you with the impression that you can simply buy or sell when it's hitting a trend line and going long or at 20 or 80. Trading is not that simple. You can, however, utilize the slow stochastics to validate the health of a trend. And then lastly, pull the trigger after the slow stochastics crosses a certain threshold. Another approach is to allow the slow stochastics to cross above a certain threshold to confirm that the counter trend move has in fact begun. This level could be 50, 61.8, or 78.6. What are those fib numbers? The downside to this approach, of course, is that the move is likely to have a few points behind it before you enter a trade. It's also a crock of bull. So while momentum oscillators are best suited for trading ranges, they can also be used with securities that trend, provided the trends take on a zigzag format. Now you say, when are they better in non-trending markets? Momentum indicators will tend to tell you when a trend has developed. It'll tell you that momentum has built. So the indicator can also be used to identify turns near support or resistance. The setting on the Stochastics oscillator depend on personal preference, trading style, and time frame. A shorter look-back period will produce a choppier oscillator with many overbought and oversold readings, and a longer look-back period will provide a smoother oscillator with fewer overbought and oversold readings. But like all technical indicators, it's important to use the stochastics in conjunction with other technical analysis tools. Volume, support and resistance, and breakouts can be used to confirm or refute signals produced by the stochastics indicator. So thank you very much for joining us today. If you want to learn more about stochastics, go to www.legacyfx.com and go over to their education center. You can get all the answers to all your questions, or you can use their online chat or email, and a financial analyst will actually contact you, and you'll be able to talk to them one-on-one, and they'll explain it to you, directly. So thank you very much for joining us, and thank you for supporting Legacy FX. Have a great trading day and a great trading week, and thank you for being part of investing.com.